Here's a number that should stop you cold. The average American home buyer will pay 2 to 3 times the purchase price of their home by the time their mortgage is paid off. The bank doesn't advertise this. Your realtor won't bring it up. But the math is brutal, and today we're going to fix it. When you sign a mortgage, you're not just borrowing money, you're entering into a decades-long financial relationship that will define your wealth or quietly drain it. Let's take a real example. You buy a home for $350,000. You put 10% down, borrowing $315,000 at a 7% interest rate on a 30-year loan. Your monthly payment is about $2,096. Sounds manageable, but here's the part the closing documents bury. Over 30 years, you'll pay $440,000 in interest alone. That's more than the home itself cost. Your $350,000 house ends up costing you $755,000 total. That's not a mistake. That's how mortgages are designed. The bank's business model is compounding interest over time. Every month, the earliest payments are mostly interest. In year one, roughly 80 cents of every dollar goes to the bank, not to building equity. This is called amortization. And once you understand it, everything changes. Now let's talk about the type of loan, because not all mortgages work the same way, and choosing wrong can cost you tens of thousands. A fixed-rate mortgage locks your interest rate for the entire loan term. Your payment never changes. If rates go up, you're protected. If rates go down, you can refinance. This predictability is why fixed-rate mortgages are the most popular choice in America, and for good reason. An adjustable rate mortgage, or ARM, starts with a lower rate, sometimes dramatically lower. A 5/1 ARM, for example, is fixed for the first 5 years, then adjusts annually based on a market index. In a high-rate environment like we've seen recently, ARMs can look very attractive. Here's the risk. If interest rates rise after your adjustment period, your payment can jump hundreds of dollars a month. Homebuyers who took ARMs before the 2008 crisis saw their payments balloon, and many lost their homes because of it. The rule is simple. If you plan to stay in the home for more than 7 years, a fixed rate almost always wins. If you're certain you'll sell or refinance within 5 years, an ARM can save you real money up front. But certain is a dangerous word in real estate. Life changes, markets change. Always model both scenarios before signing. Refinancing is one of the most powerful tools a homeowner has, and one of the most misunderstood. When you refinance, you take out a new mortgage to replace your old one, ideally at a lower interest rate or better terms. If you bought at 7% and rates dropped to 5%, refinancing could save you $300 to $500 per month. Over 10 years, that's $36,000 to $60,000 back in your pocket. But refinancing isn't free. Closing costs typically run 2 to 5% of your loan balance. On a $300,000 loan, that's $6,000 to $15,000 upfront. So you need to calculate your break-even point. How long until the monthly savings exceed what you paid to refinance? If you save $400 a month and paid $8,000 in closing costs, your break-even is 20 months. If you're planning to stay in the home more than 20 months, refinancing wins. The best windows to refinance: when rates drop at least 1 full percentage point below your current rate, when your credit score improves significantly, or when you want to convert from a 30-year to a 15-year mortgage to slash total interest. That last move is underrated. On a $300,000 loan at 7%, switching from a 30-year to a 15-year term saves you over $170,000 in total interest. Yes, over $170,000. Here's something the mortgage industry doesn't publicize. 2 people buying the same house can get wildly different interest rates, and the difference is almost entirely based on credit score. A borrower with a credit score of 760 or above can typically qualify for the lowest available rates. Someone with a score of 620 might pay 1 to 2 full percentage points more. Let's model that. On a $300,000 loan at 6.5% versus 8.5%, the low-rate borrower pays $1,896 per month. The high-rate borrower pays $2,307 per month. That's $411 more every month, or nearly $5,000 per year, for the exact same house. Over 30 years, $148,000 extra in interest paid. So what moves your credit score? Payment history is 35% of your score, by far the biggest factor. Never miss a payment. Credit utilization is 30%. Keep your credit card balances below 30% of your limit. ideally below 10%. Length of credit history matters. Don't close old accounts. And here's a move most people miss. Before applying for a mortgage, don't open any new credit cards or take out any new loans. Each hard inquiry can drop your score temporarily. Protect that number like your financial life depends on it. Because when it comes to mortgages, it does. Let's talk about the down payment, because the conventional wisdom of put 20% down deserves a closer look. The reason 20% became the gold standard is PMI, private mortgage insurance. If you put down less than 20%, most lenders require you to buy PMI, which insures the bank against your potential default. PMI typically costs 0.5 to 1.5% of your loan annually. On a $300,000 loan, that's $1,500 to $4,500 per year. That's real money that builds no equity and earns you nothing. PMI disappears once you've built 20% equity. So the goal is reaching that threshold as fast as possible. But here's the other side. If you wait to save 20% and home prices rise 5% a year, you might spend 3 to 5 years saving, while the homes you're targeting climb $50,000 to $100,000 higher. Sometimes buying sooner with less down and paying PMI for a few years is the mathematically superior choice. The key variables: how fast are home prices rising in your market? What's your opportunity cost on the down payment money? And how quickly can you reach 20% equity through payments and appreciation? There is no universal right answer. Run your own numbers with your own market data. Let's bring it all together with 5 moves that will save you real money on a mortgage. 1. Make 1 extra mortgage payment per year. Apply it entirely to principal. This simple habit cuts a 30-year mortgage down to about 24 years and saves tens of thousands in interest. 2. Shop at least 3 lenders. Rates vary more than you think between lenders. Getting multiple quotes is free and can save you thousands. 3. Check your rate after every major economic shift. If rates drop, calculate your refinancing break-even point immediately. 4. Build your credit score before you apply. Even a 20-point improvement can unlock a better rate tier. Give yourself 6 to 12 months to optimize. 5. Understand your amortization schedule. Download it. Look at how much of your first payment is principal versus interest. Then look at year 15. This single action motivates every extra payment you'll ever make. A mortgage isn't just a loan. It's the largest financial decision most people ever make. The difference between understanding it and not understanding it is quite literally hundreds of thousands of dollars over a lifetime. If this gave you even one insight that saves you money, hit subscribe. We break down mortgages, refinancing, and the real math of home ownership every week on the Loan Desk. The best financial decision you'll ever make is understanding the one you've already made.